Hello everyone! As we do every month, we're going to share with you the main insights that can be extracted from our digital top-down methodology. Our method consists of evaluating the attractiveness of European equities with regard to 4 complementary pillars of analysis. The first pillar focuses on the economic momentum in Europe. After reaching an all-time high at the end of June, it's now decelerating but remains at a high level. The economic recovery will be strong, with the consensus of economists expecting GDP growth of over 4.5% in 2021 and 2022. This is obviously a positive environment for equities in the medium term, and particularly for its more cyclical components. The second pillar is the ECB's monetary policy. The ECB is very accommodative, and the spectacular rise in inflation is driving down real rates and facilitating the diffusion of a monetary policy that will be maintained for many more. Even if the recent communication from some ECB and Fed members suggests that tightening will come, in our view it will not happen before 2022, and in a very soft way because of the strong funding needs for public deficits. This has implications for the third pillar of analysis, which is valuation. In a context where interest rates are very low or even negative, the notion of valuation becomes key. The risk premium of the European equity market stands at 6.4%. This is a generous level compared to the historical average of 5%. A return to this historical average could lead to a 15 to 20% re-rating of the European equity market. In addition, European corporate earnings growth in 2021 is expected to be 67%, with analysts' earnings revision consensus still on the upside. During the month of August, the European equity profit for 2021 was spectacularly lifted by as much as 4.5%. Finally, the fourth pillar deals with the behavioral aspect. The dynamics are bullish, as all international equity indices, with the exception of China, are above their 200-day moving average. However, the rise has been rapid, and some European indices are facing the technical resistance of historical highs. A period of horizontal consolidation cannot be ruled out in such a context. In conclusion, the environment is broadly favorable for European equities. They remain strategically unavoidable in an asset allocation. The economic momentum is supportive, the central bank is flooding the financial system with liquidity, the low interest rates justify a deep revaluation, and the market dynamics remain bullish even if the short-term dimension appears slightly less attractive. Each market correction should be seen in this context as an opportunity to increase the exposure to European equities. Thank you, and see you next month for a new monthly video by Shaheen Capital.